Corporate finance, cost of common equity. Get ready, it's time to take your chance with corporate finance. Here we are in our weighted average cost of capital, the WACC or WACC formula we looked at in a prior presentation, as well as a table type of format to get an idea of it conceptually. We're focusing in on a particular component, this time being the cost of equity, which would be here, and the cost of equity down below as well. As we think of these practice problems, we always want to have in the back of our mind the financing options, financing taking basically two primary categories, two primary buckets, that being debt financing and equity financing. We're focusing now on the equity financing not having the same kind of tax impact as debt financing. That's one of the differences between the debt and equity financing. So we first want to get to our financing options into a way that we can compare them as best we can, put them in a comparable type of format, and then take into consideration our weights. And so what we'll be focusing in on now is this particular component. How do we get to that number so that we can then use it basically in our weights and or compare it to other financing options with maybe the debt financing options as well. So we started off thinking about the debt financing options. The cost of debt is fairly straightforward because it's typically interest. So we pay interest or rent on what we borrow. But there's a tax impact that we have to take into consideration. We particularly need to take that into consideration with debt financing if we want to compare that then to equity financing, because one of the more simplified things about equity financing is that we don't have that kind of situation with the tax impact on it. So if I'm trying to compare these two situations, the two financing options, and trying to make them as like as possible to make a good comparison, I need to take into consideration the tax implication on the debt side, which is not on the equity side. When thinking about the equity side, we talked last time about preferred stock, which is probably the less common component, and it's not included really in our formula up top, but it's a good intro into the equity financing because it takes, the difference between the debt without the tax impact, without being as complicated to try to predict what the common stock kind of issuance would be, in that the preferred stock is going to be more simplified. We don't have the same kind of concept of ownership and therefore the retained earning allocation to the preferred stock, and we can therefore value our dividend payments in a similar way we do with the debt financing. We saw, however, that there is a difference in that the dividend payments for preferred stock could be imagined to basically go on, forever, whereas the amount of interest for debt would stop at some point in time, even if it's a long bond, like a 30-year type of bond. So we can take those same concepts with the preferred stock and then go to the common stock, but then we have the added complication that we have to put in place, right? How do we get to our cost of the common stock? So when we issue the common stock, we're issuing basically claims to the retained earnings, the net value, ownership interest, voting rights to the common stockholders. So we have to take into consideration the dividends that we're going to pay, and we can think about it that way conceptually. We can think about it as basically the dividends out into infinity kind of in the future, trying to basically present value what that would be. And that's one way we could basically visualize how we get to the common equity. But you can see that given the fact that we're basically giving ownership interest into the organization, it's a bit more complex of a valuation than the preferred stock. Once we have that valuation, then we can do our comparison to the debt here, and then we can multiply it times our weights to get our weighted average cost of capital and so on. But again, there's going to be more estimates most likely with the common equity than the other kind of components to get to this basic number. So cost of common equity valuation approach. So this is going to be the valuation approach. Can be more complex as we consider pricing and performance demands of current and future stockholders. So we're going to look at the pricing and performance considerations into the future. Quite difficult when you're thinking about someone who has an equity interest, because that's a piece or valuation of the entire company basically as a whole, because that's kind of like an ownership interest. So it's a larger thing that you're trying to estimate. So we could take the dividend valuation model. We have the price of the stock today. This is on a percentage basis equal to the dividends at the end of the year. This would be similar to comparing it to debt when we're talking about interest, basically on an annual basis, or the preferred stock, which has the dividends as well, divided by the required rate of return, which is kind of like the discount rate, minus the constant growth rate in dividends. These bottom two numbers, of course, are something that we're projecting out into the future, and therefore those are going to be estimates, projections, in order to get to our calculation. Another method we could use for the cost of common equity, capital asset pricing model, otherwise known as CPAM. We're not going to go into a lot of practice problems on the calculation here, but just keep in mind this model as well. We might talk about it in future presentations. It's going to be reliant on more kind of market-based information. So the required return on common stock equal to RF plus B times KM minus RF, where RF is equal to the risk-free rate of return. That's kind of like our baseline there, which is often the rate on the treasury bill securities, which is where you can find that rate. B, beta coefficient, measures the historical volatility of an individual stock return related to an index. So again, we're showing the relationship to an index, which again is kind of like a market-based item and average kind of system. And then KM being equal to the return of the market measured by an approximate index, once again being reliant in an approximate index for our calculation here. Cost of retained earnings, capital sources from common stock equity. We have the external source and internal sources. External sources, the purchase of new shares. So when we issue the shares, that's going to be one of the sources for the cost of the retained earnings. The internal source would be, of course, the earnings less distributions. So remember, when we're thinking about the issuance of the common stock, you're basically thinking from an accounting standpoint or valuation standpoint, revaluating our accounting equation. Assets minus liabilities is equity. Issuing of the shares is then providing an ownership interest, an intership ownership of the equity net value of the corporation. So the external source would then be us issuing the shares, receiving funds for that. On the internal side of things, we then have the earnings. Whenever we make earnings on the income statement, those earnings are then increasing the retained earnings. The retained earnings on the balance sheet is what's showing us at a particular point in time the accumulation of earnings, which are shown on the income statement. The income statement showing the performance to get to the end point, which is the balance sheet. The retained earnings representing those earnings over time that have been accumulated, which are part of the value of the company. And then we could distribute some of that in the form of dividends. So the dividends represent us reducing the retained earnings, what has grown over the company over time through business generation of revenue. And we're taking that value and giving it to the owners in the form of dividends, those being similar to distributions. So when you're thinking about the breakout of an equity kind of section on the balance sheet, the whole equity section as a whole, you're thinking that that's kind of like the value of the company, assets minus liabilities, basically being the value equity section. And then the equity section, we can then say, well, if there's a purchase, if we sell the stocks, that's going to be us, that represents, the common stock represents us selling ownership interest in basically the company, claim to the retained earnings, and receiving then the funds related to that from the external source. And then the retained earnings portion represents the portion of the income that has been accumulated into the company that has not yet been distributed out in the form of dividends. So retained earnings belong to stockholders and is either paid as dividends or reinvested. So the retained earnings is part of the value of the organization. Stockholders are owners of the organization. At some point in time, the owners of the organization should be getting value. They own that retained earnings, their portion related to their shares of the stock. And at some point in time, we can imagine that value to be distributed to the owners in some way, shape, or form over the lifetime of the company in the form of dividends. Or we can imagine basically, of course, the value of the company going up as the dividends are not paid out and being reinvested, hopefully in order to generate a higher return, increasing the value of the company. So that's going to be the general cost of retained earnings. So if we want to calculate the cost of the retained earnings, we're going to be looking at this on a percentage type of basis. Cost of retained earnings is equal to the rate of return on the company's common cost. The formula below represents the required rate of return on common stock and the cost of equity in the form of retained earnings. So the cost of common equity in the form of retained earnings, we're going to calculate this and call this the cost of retained earnings. We'll change it slightly in the future slide to take into consideration flotation costs to distribute the stock out. This is going to be the dividend at the end of the first year. So now we're just looking at the dividend at the end of the first year. We're going to divide that by the price of the stock. The price of the stock is, of course, what we sell the stock for. We would be issuing the stock onto the stock market. Remember, when you think about purchasing and selling on the stock market, most purchases and sales aren't coming from the company. They're being sold between each other on a publicly traded exchange. In this case, we're talking about the company itself issuing the stock. Therefore, the stock price is what the company will receive. They will still issue it at the market price. They're going to sell it for as much as they can, but then that money is going to be going to the company. So we're taking a look at the dividend at the end of the year. That's what we're going to have to pay out. That's similar type of calculation we saw with the debt financing when we're looking at interest on a yearly basis, or with the preferred stock divided by the price. But then we need to add to that the constant growth rate of the dividends. And that's going to take into consideration kind of the increase in the valuation of the company as well. So if we look at the calculation down below, it might help us to make sense of this. We have the dividends per share, we're going to say is the $4. That's what we're going to be paying out, we're going to say annually here. And then we divide that by the common stock price, which is going to be the $90. That's going to give us our 4.44. This is a similar calculation as with the preferred stock, also similar to the debt when we're trying to come up with this percent. With the debt, we would then have to take into consideration tax impact. There's no tax impact here. We don't have to worry about that. But we have also the growth kind of component that we need to take into consideration. And this is where the big estimate would be, in this kind of calculation, that would be the constant growth rate of the dividends, that we would have to estimate what the constant growth rate of the dividends would be, and then add that to our 4.44 to come up with our cost of the retained earnings, something that we can then see on a percentage basis and possibly use it to compare then to other types of financing methods, possibly something like debt financing. So we could also have the cost of common stock. This is going to be a similar calculation here, but now we're going to take into consideration the flotation costs, the cost of us issuing the stock. So we have the greater than the cost of retained earnings due to flotation costs. These are the distribution costs that we're going to add into the calculation. It's the required rate of return for the current shareholders. So when we're thinking about our rate of return for the current shareholders, we want to take into consideration then the flotation cost. The cost of common equity in the form of retained earnings, you'll recall, is what we just looked at. Dividends at the end of the year, dividends at the end of the first year divided by the price plus the constant growth rate of dividends. One change now here, that's going to be the flotation costs in our formula for the cost of common stock, which is going to be the dividends at the end of the first year, same thing. But instead of dividing by the price of the stock only, we're going to take the price of the stock minus the flotation costs. The flotation costs being that one-time thing, because this is not something that we're going to pay annually, right? It's just the cost of us issuing the stocks as we first issue them. So it's a one-time cost. So instead of getting the price into the company, we're really getting the price minus that one-time costs. And then we will do the same thing and add them to the constant growth rate of dividends. So it looks something like this in a table type of format. It's going to be the dividends per share. We're going to say it's $4. The net price now, I'm going to calculate. This is going to be this bottom calculation. Common stock price was $90 minus the flotation costs. Here's the flotation costs, different than the dividends that we're going to have to pay. Dividends paid annually, flotation costs paid one time. Therefore, if we issue the stock for $90 on the market, someone paid $90, but we got to pay someone to get those stocks out there of the $3, meaning we're really getting $87 on what I would call like a net price. So if we take now the $4 divided by the 87, we get the 4.6. Then we're in the same situation we were at before, where we need to then calculate and add the constant growth rate of dividends, that being the 6% to get to the 10.6. Now, if you kind of mull this over, obviously, once again, the 6% is going to be some type of estimate here. You can kind of try to think about why this makes sense in your mind. You could basically think that this 4.6 is the similar calculation of what we're paying annually as compared to what we're going to be receiving. And then this 6%, we're trying to basically, you can think about it as present valuing, the future cash flows that we basically thought about before, meaning you can conceptually think about the ownership of the company being the equity. The equity is going to be distributed over the lifetime in some way. in the form of dividends and try to basically present value this, right? So this is, you can think about this as an attempt to think about, the return what we have to give back in terms of the dividends, and this is an attempt to basically then value kind of the growth on the equity on the valuation side of things, but use a kind of a cash flow method to do so. But in any case, then we get to the 10.6, the 10.6 being something that we have a percent now that we can then compare to other financing options, such as the debt financing. Once again, it's not perfect, because when we think about the debt financing, we do have some certain differences, meaning, for example, the debt financing, we're comparing interest up top, and the interest is something paid annually. But even though we can kind of take into consideration the tax impact of it, even after that, we have a maturity date for the debt financing for bonds, even if it's a long maturity date out into the future. This $4 of dividends, in theory, can go on basically forever. And then, of course, we have the added complication down here of the expected growth calculation. To know exactly what that is, that's a more complex type of calculation than a dividend, where you basically have a fixed set of terms. It can be a little complicated to figure out the after-tax impact, but there's less unknowns there than trying to value the company and get that expected growth rate.